In 2026, the United States finds itself standing at a financial crossroads that feels heavier than ever before. And when we talk about a national debt crisis, we are not talking about a distant abstract number on a government website. We are talking about a figure that has grown so large that it shapes the future of every American household, every taxpayer, every business owner, and even every global investor watching from abroad. The national debt has crossed historic levels, and the question that keeps echoing across newsrooms, Wall Street trading floors, and kitchen tables is simple but powerful. Is America heading toward a financial breakdown? To understand where things stand today, we first need to understand what the national debt actually represents. The national debt is the total amount of money the federal government has borrowed over time to cover the gap between what it spends and what it collects in taxes year after year. When government spending exceeds revenue, the difference becomes a deficit, and that deficit is added to the total debt. This cycle has repeated itself for decades, but in recent years, the pace has accelerated dramatically. The United States now owes tens of trillions of dollars, and that number continues to rise, not by millions, but by billions every single day. Interest payments alone are consuming a growing share of the federal budget, and this is where the situation becomes serious, because when interest costs rise, they limit how much money the government can spend on defense, healthcare, infrastructure, education, and social programs. The government is essentially paying more to service its past borrowing than to invest in its future. One of the biggest drivers of this debt growth has been emergency spending during times of crisis. The financial crisis stimulus programs, the pandemic relief packages, massive infrastructure investments, and defense spending commitments all added to the total borrowing. At the same time, tax cuts reduced government revenue, which widened deficits even further. While these actions were often justified as necessary to stabilize the economy, the long-term consequence has been a rapidly expanding debt burden. Another factor making 2026 different is interest rates. For years, the United States benefited from historically low interest rates, which made borrowing cheaper, but as inflation surged in the early 2020s, the Federal Reserve raised rates aggressively to stabilize prices. Higher interest rates mean higher borrowing costs for the government, and when you apply higher rates to trillions of dollars of debt, the result is a dramatic increase in annual interest payments. This creates a dangerous cycle. The government borrows more to pay for existing obligations, and the interest on that borrowing grows even larger if revenue does not increase at the same pace. Deficits continue expanding, and the debt grows even faster. Financial analysts warn that if this trend continues unchecked, the United States could face serious fiscal stress within the next decade. Now, some argue that America is different from other countries because it issues the world's reserve currency. The US dollar is used in global trade, central bank reserves, and international transactions. This gives the United States unique advantages. Investors around the world buy U.S. Treasury bonds because they are considered safe and stable. As long as demand for U.S. debt remains strong, the government can continue borrowing without facing immediate crisis. But confidence is not permanent. It depends on economic stability, political reliability, and fiscal discipline. If global investors begin to question America's ability to manage its debt responsibly, borrowing costs could rise even more. And if demand for Treasury bonds weakens significantly, the government may struggle to finance its obligations smoothly. Political gridlock has added another layer of uncertainty. The recurring battles over raising the debt ceiling have created moments of market anxiety. When lawmakers delay agreements, markets react sharply. Credit rating agencies have already downgraded U.S. debt in past disputes, citing concerns over political dysfunction. Even temporary fears of default can shake global financial markets because treasuries sit at the center of the global financial system for everyday Americans. The debt crisis may seem distant, but its effects are already visible. Higher interest rates impact mortgage costs, car loans, credit card payments, and small business financing. When the government borrows heavily, it can crowd out private investment, pushing up borrowing costs across the economy. Inflation fears can also emerge if markets believe excessive borrowing will eventually lead to money creation or currency devaluation. The long-term concern is slower economic growth. When more government revenue goes toward paying interest, less is available for productive investments. This can reduce infrastructure improvements, limit research funding, and weaken social programs. Future generations may face higher taxes or reduced benefits as policymakers attempt to stabilize finances. Supporters of continued borrowing argue that as long as the economy grows faster than the interest rate on the debt, the burden remains manageable. They point out that the U.S. economy remains one of the largest and most innovative in the world with strong productivity potential and deep capital markets. They believe growth can gradually reduce the debt to GDP ratio without drastic spending cuts. Critics, however, warn that relying solely on growth is risky. Demographic trends are shifting. The population is aging. Entitlement programs like Social Security and Medicare are expanding while the workforce growth rate is slowing. This creates structural budget pressure that will not disappear without reform. In 2026, discussions around fiscal responsibility have intensified. Some lawmakers propose cutting discretionary spending, others advocate tax reforms to increase revenue. Some suggest restructuring entitlement programs, while others push for a balanced combination of spending reductions and revenue increases. Yet political compromise remains difficult, and without bipartisan cooperation, long-term solutions remain out of reach internationally. Other nations are watching closely. Major holders of U.S. debt, including foreign governments, evaluate their exposure carefully. Any signal of instability could influence their investment strategies. Although there is currently no immediate panic, the conversation around diversification away from U.S. Treasuries has grown louder in some regions. Financial breakdown does not happen overnight. It is usually the result of gradual erosion of confidence, rising borrowing costs, and policy paralysis. If the United States continues on its current trajectory without structural reforms, the pressure will build year after year. Markets may tolerate high debt for a long time, but once confidence shifts, reactions can be swift. At the same time, it is important to avoid extreme alarmism. The United States still has significant strengths: a large, diversified economy, advanced technology sectors, strong military power, and deep institutional frameworks. These advantages provide resilience that many other countries lack. The real question is not whether collapse is inevitable, but whether policymakers will act before risks compound further. The coming years will likely determine the direction of America's fiscal future. Decisions made in Congress, budget negotiations, tax policy adjustments, and Federal Reserve actions will shape how manageable the debt remains. Economic growth trends, inflation stability, and global demand for U.S. assets will also play critical roles. For viewers trying to understand what this means personally, it comes down to economic stability, job security, investment markets, and the value of savings. A severe fiscal crisis could trigger market volatility, currency pressure, and economic slowdown, but responsible reforms and steady growth could gradually stabilize the outlook. As 2026 unfolds, the debate continues: is this simply another phase in a long history of U.S. borrowing that will eventually balance out through growth and policy adjustments, or is it a warning sign that deeper structural changes are urgently needed? The numbers alone tell a story of unprecedented scale, but the outcome depends on decisions yet to be made. The United States stands at a financial crossroads with trillions in debt, rising interest obligations, political division, and global scrutiny, yet also with economic strength, innovation capacity, and global influence. Whether this moment becomes a manageable challenge or a turning point toward financial breakdown will depend on leadership, discipline, and long-term planning. The clock is ticking and the world is watching.